And our first speaker today is our own Sharon Owen, who is going to tell us just a few minutes about national philanthropy, the International Convention, and I'm going to turn it over to Sharon.
Thank you, Alex. So today I get to share with you a little bit about the experience that is attending the international conference as the Chamberlain Scholar. Chapters all over have this scholarship, and I had been applying for it for 4 years, and I was so excited when I finally won. That meant I got to go to San Antonio for a few days and absolutely hear from experts of every shape and size. I just want to show you this. Can everybody see that? Some of the offerings from the conference this year. Julie Strum is here with Cooper Reese. She and I were actually roommates. The scholarship covers your conference fee, and then $500 minus $10 that you pay yourself out of your own pocket. It's your personal contribution to attending. And then $500 in expenses. And this scholarship, it's called the Chamberlain Scholarship Application. It's online. You can go. Be sure, Valerie, what's the deadline?
September 30th.
The end of September. So you have a whole month. So everybody be sure, if you've never attended international conference, you definitely want to do it. It was an amazing thing. I attended programs on annual giving, small shop success, love your donor, best practices, soliciting major donors to yes, philanthropy kaleidoscope, journey deeper inside the donor's brain. I like that one. The marketplace, and that was a wonderful experience where if you've ever been considering having a certain vendor, their product or something in that marketplace, it's a pretty good bet somebody from that company will be there, and you can actually firsthand hear from one of their representatives, touch it, feel it, experience it. So that was really good. Not only that, they had wherever you are, and they usually pick a fun venue. The venue next year is Baltimore on the harbor. Going to be absolutely fabulous. March 29th through the 31st of 2015. So, but one of the things that they had in San Antonio was called San Antonio Nights, and we went to the AFP After Dark party. That was an absolute hoot. It was just lots of fun. And I don't know about for you, but here on the local level, this monthly meeting kind of enables us to have that wonderful discussion you guys were having before we started. Meet one another, get help from one another. Diane, where's Diane? Diane Nelson in the back. She was last year's scholar. So I know she will agree with me. That opportunity to go and experience this, but on an international level, is amazing. At orientation, I was sitting there, and you just naturally kind of, I'm an extrovert, so you naturally kind of look at the person next to you and say, "Hi, I'm Sharon Owen from Asheville, North Carolina." And they respond, "This woman was from Rome, Italy." And she was sitting next to me. You can't experience that just anywhere else. And everybody has this wonderful drive and ambition. And when I started officially fundraising in 2008, I think I was a little worried that people would try to, keep the information for themselves. That's my donor, or there's not enough to go around. And AFP has just been anything but that. Everybody says, "How can I help?" We have the mentor program. What would you like to know more about? And it's that kind of thing. We're all on the same team trying to better our community. And so I hope that if you've never attended international conference, that you will go online to our website and download that application and apply, because it's fabulous. And two, I wanted to share two quick things that I learned. One of them was that when you're creating your communications and you're trying to, especially written communications, but it could be email, whatever, you're trying to get your donor captured, their attention. It has been proven, there was this data, it has been proven that you can raise a lot more money with a sad-faced child or a pitiful dog than you can with a happy-faced, smiling child. Because the perception is, they don't really need me, they're happy. So isn't that an aha? So I thought that was really fascinating. And then the other aha for me was in our communications, don't talk about, oh, well, we did this and we did that. No. How should you frame that? It should be framed instead as your dollars enabled this child to have a meal. Your dollars enabled us to care for 1,200 people on our last visit to Haiti. That's the kind of thing. Turn it around, because it's not you doing all of this. It's these other people enabling us to do these wonderful things. So thank you. I encourage you, please go online, submit that application, and good luck.
Thank you.
Hope it doesn't take you forever.
This is really serious. It's a serious opportunity that you really should be thinking about doing. Okay, our featured speaker today is Michelle Tracz. She is a CPA and also a certified fraud examiner with her own company. She does a lot of work with nonprofits, and her title today is The Financial Statement Puzzle, Unlocking the Mystery, and she'll tell us the rest of it. Thank you, Michelle.
Thank you. Well, thank you all for coming, and Chad's going to help me out here. He's going to pass out some hard copies of this presentation that we're going to go through. Hopefully you all can see or not see. So, as Alex mentioned, I am a CPA and a CFE, which is a certified fraud examiner. I also sit on a couple of boards of not-for-profits as well, and I actually had a board retreat last night, and we were with Angela Kemper. I'm sure many of you know her. And she had an interesting comment last night as she's talking to a bunch of board volunteers, and said she understood that fundraising to us was akin, to sort of fear of dying, fear of flying, fear of heights. And I thought, golly, if that's the case, then you all here, you would probably rather be having a tooth pulled or something than talking about finances and accounting. So thank you all for coming, and hopefully what we're going to talk about today in this very short period of time is just giving you a few tidbits, a few pieces, a few nuggets of information that hopefully can help sort of unravel this financial statement mystery for you. There's a lot more detail that can go into it, a lot more information that we can certainly present to you, but again, this is just sort of somewhat of an overview for you. So let's talk a little bit about our agenda, and like I said, you have a hard copy there, so please feel free to take notes. And also, I was talking with Chad earlier, and he mentioned he's just moved here a few years ago from a very far away place. Sometimes I feel like that was me as well, 17 and a half years ago. I moved here from the Northeast. So you can take the girl out of the Northeast, but you really can't take the Northeast out of the girl. So if I'm talking too fast, please stop me. If you have a question, please raise your hand. I'm happy to answer any questions as we go along. So our agenda is going to be simply accountants are from Mars. I'll explain, but I'm sure you'll agree. Don't tell your accountant I said that. The purpose of a set of financial statements. There is a purpose for them, of course. What are they? What are financial statements, really? Oh, by the way, all financial statements are not created equally. So we'll talk a little bit about that and why is that so. And then, of course, what is unique about not-for-profits? You are unique. We know that. You're special. And there's a few special things that we do on the financial statement level that are a little bit different if you're more used to for-profit financial statements. And we'll talk about a couple of those key differences. And then there will be a quiz. I didn't say test. Don't panic. Just a quiz. a few questions, and there'll be some rewards if you can get through those. So hang on, we're getting there. Okay, so accountants are from Mars. I sat and listened to all the introductions, and you all from some very prestigious not-for-profits, and again, thank you so much for coming. But by a show of hands, could you raise your hand if you're a fundraiser or development professional in a not-for-profit? Just so everyone can see, that's the majority of you folks. What about volunteers, board members, other laymen for not-for-profits? Great. Finance folks? Good, a couple, good, finance. Okay. Sorry, that was a little plug for finance. So I just wanted to kind of visually see, and hopefully you all got a chance to see as well. You all come with just a varied background, experiences, and your expertise. And so you're looking at things differently. Everyone views things a little bit differently. And that's important for you to recognize that, you bring that skill, you're dedicated to your mission, but put a set of financial statements in front of many of you and you start to feel a little queasy. I totally understand. But you're not alone. There are plenty of people out there, believe it or not, attorneys, judges, jurors, a lot of your donors don't understand financial statements either. So hopefully you'll get a few tidbits, like I said, and just so you know, you're not alone. Accountants are from Mars, like I mentioned, and Sarah and I were talking, and she was sharing a story with me about how she can talk to some other finance folks, and they'll go on for days with lots of detail, and that is true. You may ask me what time it is, and I'm going to tell you how to build a watch. From start to finish. That's exactly what I'm going to do. So it's full of detail, and so when finance folks come at you, just know that's their world. They're coming at you with detail. They want to explain to you everything. So it's important to understand we're all kind of coming at this from different angles. So what is a CPA? I mean, we all know a CPA is a certified public accountant, but not all CPAs are created equally either. So you kind of want to make sure you understand, what their expertise is. We all have different areas of expertise. There's tax preparers. I'm not a tax preparer. There's auditors. I'm not an auditor either. So we all have different levels and different areas that we have expertise in as well. And then not tax returns, all tax returns are audit reports, not all audit reports or all reports produced by CPAs are audit reports. CPAs can produce other reports called compilations, you may have heard of those, reviews, as well as audits. These are different levels of service you're going to get. So when you look at a set of financial statements, make sure you're understanding what you're looking at. So, and it goes in that order. Compilation is simply a compiled information. A review is just basically what it sounds like, a review, just very light review of the data and the details that went in to create the financial statements. And an audit is the highest level of service. It is going to be just what it sounds like, an audit. They're going to go in and audit all the detail through a statistical sampling and materiality level and give you audited financial statements. So something to be thinking about. They're different. And then, of course, why should you care? I'm preaching to the choir. I know that. It's your fiduciary responsibility as part of a not-for-profit. We're counting on you to make sure that you understand what's going on behind the scenes, that you're looking at the financial statements, or maybe you sit on a board of a not-for-profit, and it's important for you to understand those as well. So just for fun, because I enjoy looking up Wikipedia stuff. I went on Wikipedia and looked up the definition of the purpose of a set of financial statements, and boy, it was fun, let me tell you. So I'm just going to read this. The objective of financial statements is to provide information about the financial position, performance, and changes in financial position of an enterprise that is useful to a wide range of users in making economic decisions. Financial statements should be understandable, relevant, reliable, and comparable. Reported assets, liabilities, equity, income, and expenses are directly related to an organization's financial position. Phew, that's a mouthful. So out of that, I highlighted, obviously, the key concepts. And so the key components that I want you to understand is, it's there to provide information, useful to a wide range of users. Well, that's depending. So hopefully we can get there, but you know, that is the intention. It's supposed to be understandable, relevant, reliable, and comparable, of course. You know, we know that. But anyway, that's what the purpose, the definition of a set of financial statements is. So starting from that basis, the next question, of course, I know you're all thinking is, okay, why do we do them? Well, we do them for some really good reasons. We do them because it's to demonstrate good financial stewardship and transparency in our organization. We also do them because they're good metrics in there. We can draw out information about the organization. And if you don't do them, I just want you for a minute to think about the consequences. I've been fortunate enough to work in nonprofits and with boards of non-for-profits, and we look at financial statements very regularly. There are some that don't have that luxury. So if you're not looking at them at least quarterly, maybe you're looking at them once a month, that would be great, but it is important. And it's going to help you identify also some possible misstatements, some errors, or even some wrongdoing. I don't have to repeat for you the news of how not-for-profits do have embezzlements and fraud going on. So it's important to make sure you're looking at the financial statements. They can point those things out to you as you're looking at them. And then what can they tell you, of course, as we mentioned, we know, they can tell you what you're doing or how the organization is doing against a budget, against prior year. Are you making any money? And of course, as you know, by the way, it is totally okay for a not-for-profit to make money. We want that. A lot of not-for-profits think, I have to break even. I work with a lot of small organizations that are like, well, we have to spend this money and we want to break even. Well, that's great, but making money is okay. And the great thing about not-for-profits is you turn that back around, back into the organization, those profits. So how are we spending our cash? Are we meeting our commitments to the investors, the owners, our donors, our board, our community? And then also financial statements can tell you, believe it or not, if we had to close shop today, what do we owe? Who do we owe? And who owes us? So it's really important to know, it'll tell you that. So that's kind of the reasoning behind or the purpose of the set of financial statements. So what are the financial statements? This is really cool. So at your next cocktail party or fundraising event, I want you to use some of these words. You're going to be a rock star. It's going to be awesome. You're going to kick it. All right, so the statement of financial position. Had anyone heard of the statement of financial position? You probably have heard of something called the balance sheet. That's probably a little bit more familiar and more used, but it's also called the statement of financial position, one and the same. Statement of activities, again, probably not too many people may have heard of that terminology, but maybe you've heard of the income and expense statement or a P&L, all the same thing. And a statement of cash flows. That's a particular statement that has been ignored widely from all avenues for a pretty long time, and it's really kind of coming back, if you will. It's a really important statement, but it's called the statement of cash flows, and it's exactly what it sounds like. It tells you where your cash is flowing. And then there's the notes that accompany your financial statements. If you have the pleasure of reading your audited financial statements, if you get those in your organization, you'll see after all the numbers, you see a bunch of words. It's kind of like, what? Those are the notes to the financial statement. So that's basically, in a nutshell, what they are. All right, so you're going to have to remember that. Use that at your next cocktail party. Those are the terminologies. So let's start with the statement of financial position. This is that balance sheet. Here's a few key things. This is where you can apply these concepts to any set of financial statements. This goes for any balance sheet. A balance sheet is going to reflect the assets, the liabilities, all that information at a moment in time. So you want to look at the date of your balance sheet, and it's at that moment, that's what it was at that moment in time. It's organized in order of maturity for liabilities and liquidity for your assets. So the most liquid is at the top to the least liquid, and the earliest to mature is first to the long is to mature, or the long-term liabilities. And it's called a balance sheet, believe it or not, because it does balance. And if it doesn't balance, you got a problem. So it will always balance. Let's look at a sample, and hopefully it's probably a little bit hard, but maybe you can see a little bit better on your sheet. This is A sample financial statement is the balance sheet. As I mentioned, the report date means something, so make sure you're looking, it would always have a date at the top. This one says as of June 30th. And as I mentioned, it's in order of liquidity. So you start with cash, always, that's the most liquid. Receivables, a little less liquid. Then it goes into other assets. Same thing on the liability side. You can see it starts with accounts payable, the most liquid, all the way down to your long-term liabilities. And as I mentioned, it's always going to balance. So here you have your assets, the total assets, and that is going to equal your total liabilities and equity down at the bottom. And I've circled those, and hopefully you see that on your sheet as well. So that's an accounting rule. Like I said, assets are always going to equal liabilities plus net assets, and in the for-profit world we call that equity. So again, it's always going to balance. So I don't know if many of you knew a few of those concepts or not, but I give a lot of presentations to boards, and they're always fascinated. Oh, I didn't know that. Now I can really apply those rules to every balance sheet I read, and that is true. The other thing I wanted to point out is at the top, I've got this particular financial statement is noted as unaudited. And so again, as I mentioned before, you want to be careful about the types of reports you're looking at. So in this case, it's an unaudited financial statement. No one's gone through and made sure that those numbers are completely accurate via an audit process, but we're presenting them to you. Either maybe you're reviewing them internally with your board or for other reasons, but just to make a note, it should say it was unaudited or for internal purposes only. So the next statement I want to kind of go over in more detail is the statement of activities. This is that P&L, the income statement, whatever name you want to give it. This is actually reflective of over a period of time. So it's going to tell you it's from January 1st through June 30th, and it's going to tell you the totals for that period in time. If it says it's a calendar year operation and the statement says the date at the top is 12/31, then that's going to be your whole calendar year net effect of the transaction. So it's going to be over a period of time. The statement of activities, it's often going to be grouped by type or program. It may be grouped by restricted assets, temporarily restricted assets, undesignated assets, may be grouped by program. Here's our social services program, here's our child care program, here's our Meals on Wheels program. So it can be grouped either way, and you'll probably see it in both. And just so, as I mentioned before, in a not-for-profit, we don't call it equity, we call it net assets, and when you increase your revenues, you're going to increase your net assets. Similarly, expenses are going to decrease your net assets. So let's just take a quick look at an example of an income statement. And so again, as I mentioned, it's going to be over a period of time. This one says it's for the whole calendar year from January 1st to 12/31. And again, if it's a fiscal period, it's always going to state it, so you'll know exactly the period it's covering. And I put that arrow to show you the dates up there. This one is particularly grouped by type. It shows unrestricted, temporarily restricted, and permanently restricted. As I mentioned, also can be by program. And again, as I said, revenues increase and expenses decrease your net assets. And of course, you can be a not-for-profit and make money. In this particular case, this poor company here is not making a profit. But how you increase those net assets is you take that revenue or expenses net number, you add it to your beginning net assets, and it will equal your ending net assets. And so those are just some key concepts to understand on a statement of activities and or P&L or whatever you want to call it there. Here's another example. This one is grouped by program. So again, we're looking at a similar company, but instead of by restricted assets or permanently restricted, where you've got healthcare, social services, food services, it's all grouped over by program. So maybe you're familiar with seeing yours in that way. So the next statement is the cash flow statement. And this one is very important. I mentioned that it's been overlooked for a while, and it can be very complicated to understand. And we spend a whole day, we do a seminar whole day on just understanding and how to prepare a cash flow statement. If your organization is not preparing one, I strongly suggest it. It can tell you a lot. It is exactly what it sounds like. It tells you how you're using your cash. Where is the cash coming from? Where is it going to? It is very different than the financial statements that we just looked at, whereas it tells you the net values or the totals. This is going to tell you from a cash perspective. And if you're an accrual basis entity, they're very different. I didn't show an example. There are some not-for-profits that don't use a cash flow statement, and there's a very good reason for it. A lot of not-for-profits have a lot of investments. They tend to move around a lot, and it can lead to a misleading cash flow statement because you're moving those investments to and from different accounts. So it may be not important or not relevant for your organization, but it is helpful. And if anyone has, do you have a question?
Are you suggesting that be part of the interim or monthly?
Absolutely. Yeah, absolutely. It's a great tool. And like I said, I don't have an example here for you today, but it is a really good tool. And we do it for our not-for-profit organizations that we work with, and we show them this is where the cash is going. A lot of not-for-profits, and I'm sure you experience this as well, focus a lot on the cash. It's tight. We're limited on resources. So when you look at the financial statements, that tells you one picture. When you look at that cash flow statement, it may be telling you a totally different picture. And so as we're focused on that cash, having that cash flow statement could be really handy. And I'd be happy to give some examples or go over it another time, or you feel free to call me. But it can be misleading for some, which is why I didn't bring up an example here. And then the last one we talked about, which I'll show you a quick example here, is those notes to the financial statements. You know, we accountants, we love words too, not just numbers. But the notes are really important. They're going to give you a lot of information. And like I said, if you've seen a set of audited financial statements in there, maybe some good explanations of, you know, where the restricted donations are and what they're restricted for, or for how long those temporary donations are restricted. So that's all going to be in the notes for you, and really important information there. Like I said, it can explain very specific items. It's going to also disclose for you the accounting treatment, some reasons for your estimates, why you used that particular process, or you decide to depreciate your truck over 2 years rather than the 7, or took 10 years, or whatever it may be. It's going to explain it there. And it's going to really provide a more comprehensive assessment of the financial position of the agency. So remember I said not all financial statements are created equally. They aren't. And just to start off, let me just tell you, financial statements are historical. They're only historical. They are not going to predict the future for you, no matter how hard you try. So it's a good benchmark is really what they are. And you really don't want to let too much time go by before looking at your different financial statements. As I mentioned, if you're looking at your financial statements annually, try to do it quarterly, or even if you're doing it quarterly, try doing it monthly. And then statements can be presented really for different purposes. So you may have statements that you're using for internal use only. Like I mentioned, I work with a not-for-profit. It's a very small not-for-profit, and the users of their financial statements, the readers, they really have trouble understanding that a not-for-profit has to record revenue when you receive it. So we get a grant June 1st, our fiscal year closes June 30th, and then July 1st comes and we're spending money for that grant, but there's no money. Where did the money go? Well, because we received it in June, we had to record it in that prior period. So that's a hard concept for lay people in particular to understand, and it's the right way to account for things. Generally accepted accounting principles do say, and if you have audited financial statements, when you receive the money is when you have to record it as revenue. But we in this small not-for-profit, we defer that so that they can match the revenues against their expenses. It makes more sense for them. But we call that internal only financial statements. We know it's not meant for external use. We just look at it internally and it makes them feel better. So that you want to make sure you understand that what you're looking at may be internal financial statements only. We admittedly sometimes prepare financial statements just for a particular grant or a particular funder. It's not pretty, we don't like to admit it, but we do because they ask for things in a special way, or they want numbers presented in a specific pattern. So we will present financial statements just for them. So you want to be careful and look at those. We also have financial statements we may present for banks or lending institutions may be different. It may be different on the tax return or for tax purposes. So there's a whole array of different types of financial statements that we prepare, and it's important to know what you're looking at. So again, I mentioned that you're unique, and we are. Not-for-profits are very unique. And there's a couple of really big, specific points I want to make about why not-for-profits are unique. And one of the most important things to talk about is this revenue recognition. I started to talk a little bit about it, about how we are required to record revenue when we receive it. And that revenue recognition is probably the biggest difference you'll find with not-for-profit agencies versus the for-profit world. The first thing we do, we finance people, and you hand us the money, you're out there getting that money, and we love it, thank you so much. And you hand us the big check, and we say, that's great. What's this for? Where did this come from? It's important for the finance folks to understand that so that we can record it properly. And so as we're talking to the fundraising and development professionals in our organizations, and they hand us this big check and they say, oh, that's from Mr. Smith. He said that's specifically for the food service program for our fiscal year 2015. Got it, okay. Well, that is restricted. It has caveats around it. It has a specific time we're supposed to use it. It's for a specific purpose. And that gets recorded totally differently than, you know, someone who came by and said, I really love the work you do. I just want to give you money, and here you go. Use it any way you want. So, so we want to make sure, you know, we understand kind of what that money is for, where it's going to. So we'll always ask, what is this? There are times when you get money and it's conditional. And I'm sure you've seen a lot of that. I'll give you $100,000 if you can raise $100,000. So if I gave it to you now and you didn't raise the $100,000, you owe me my money back. If the condition was, I want you to serve, you know, 100 meals, and then I'll give you $10,000, you have to serve the meals. So we want to make sure we understand that if it's conditional, we can't record it until the condition's been met. So that won't show up in our revenue when you're looking at those financial statements. So that's important to recognize and know that you're dealing with a condition. It has strings attached to it. We also have wonderful donors that pledge money, and they give us a promise or a pledge, and that's great. And hopefully sometimes we can even get that in writing. There's a lot of not-for-profits that I work with that, you know, we set sort of kind of defined limits. If it's less than $10,000, say for example, we'll take it on a handshake, as we mentioned, or if it's more than that, we want to get, you know, an email or a letter or some sort of confirmation that says this was a good promise that they're going to pay it. If it's an intent, I intend to give you money for your wonderful organization, we can't record that either. You can only record a promise, and it goes into a receivable. So just being conscious, I'm sure you guys already know this, of how you solicit money when you put out your solicitations or you're asking for money, being very clear on intent versus a promise to pay. And of course, we love the undesignated, unrestricted money. It's terrific. It's gold, right? So we can use that any way we want to. And it also comes at the highest risk because the majority of our expenses have to go against that unrestricted money. But we can also have unrestricted designated. Maybe some of your boards have decided that they want to set aside some money for a capital improvement or to buy a new piece of equipment, or they want to set aside for a specific purpose. That would be considered unrestricted but designated. And then of course I mentioned we also have restricted. It can be temporarily restricted or permanently restricted. And by the temporarily restricted, usually we're talking about restrictions for a time or a purpose that you have these funds. It could be either or both. And if it's permanently restricted, it's usually an endowment. We're probably not going to spend that money. That's really a fixed amount, and we probably won't spend that principal. They it's a good endowment, and we'll just live off the interest. And just so you know, grants, of course, you know, they come in a combination of ways. And I'm sure you've all experienced this, but we finance people sit in that back office with that grant paperwork just plowing through word by word, and we try to go through it very carefully. And I encourage you to do the same. They can be tricky. A lot of times they're a combination of things. They'll give you money and it may have a condition attached. It may be restricted in one way or another. Usually it's restricted for a specific purpose, but we can get into some pretty difficult positions if we don't understand truly the nature of that grant money and why it's being given to us, and making sure we record it in our financial statements correctly. I also want to mention one more thing. If you receive a pledge that is greater than a year, you know, it's going to be something that they're going to pay out longer than a year's time, that may be something you might want to consider having to, what we call, evaluate it for its, you know, current value. It's sort of like doing a present value analysis on that money. We may or may not get that full amount. So just for those large organizations that get large donations that are out in a long period of time, you have to kind of do like a net present value evaluation. It's called discounting, or really evaluate the collectability of that pledge. So just something to keep in mind. So that's a big difference for not-for-profit accounting, and that's probably why you see your finance folks coming up to you in tears, trying to understand what all this money you've done such a great job getting for us. One of the other big differences is this whole idea of net assets. I'm sorry, you have a question?
Can I ask a question?
Sure.
Go back a second. About discounting, we just had this conversation with our accountants. You made it sound like it's a suggested practice. They made it sound like it is a must-do.
It probably is for your organization, or for how much you have, or how long out those donations have come to you. So I would definitely go with their advice, but I said it in a maybe because some organizations may not have the same situation. But it is important. And what they're trying to do on the financial statements, and I assume you said your accounts by auditors, they're auditing, they are obligated to make sure that the financial statements reflect actual recoverable values. So if it's a large donation over a long period of time, that would need to be reflected sort of what's truly collectible, and really sort of discount that, if you will. And that's the whole obligation. Thanks, great question. Does anybody have any other questions?
I'll stop you now. Maybe this is the wrong time. In a minute ago, you said that intent is not the same thing as promise. And for those of us that, we have a community foundation person here, for those of us that do fundraising with many of our donors who have donor advised funds and that sort of thing, and then we have to figure out, okay, how do we list this in some understandable way? So we can't do a pledge because that's a promise, even though it's not legally, you know, enforceable. So if we say something like this is an intent to give, or an intention to give, is that acceptable in your world?
It depends on kind of to whom and where and when this information is being presented. And in different ways that is totally permissible, but on an audited financial statement, for example, it may be that the intent can't be carried forward. In other words, it have to be recorded or presented in a different way. But for foundations, there may be some extenuating circumstances where it's...
Well, I'm talking about Mr. Gottrocks, who has a donor advised fund. And he says, I can't promise you anything, but my intention is to give you $100,000 a year for the next 5 years. What I'm hearing you say is that's fine for the, let's say, the campaign auditing process, but in a real financial statement, his commitment to you is zero.
Unless you have it in writing, then he says, I will give you this money, yes.
But it's a donor advised fund, so he can't do that, correct?
Well, yeah, he could say, through my donor advised fund, I plan to, I pledge that you will get X amount of money. And if you got that in writing, and even though it's coming from the donor advised fund, absolutely you can record that. But if you don't get that, and he just says, I intend to, that would be my intention, is to give you $100,000.
Oh, no, yeah, okay.
Now, we're doing a campaign right now, and specifically for people giving through a donor advised fund, we developed a a modified pledge form
Yeah.
that is a statement of intention.
Right.
And so the bottom line question is, one donor who filled out a pledge form made a commitment for $250,000. We booked that revenue.
Yes.
If someone makes a $200,000 commitment through this statement of intent, can we book that revenue as well?
My suggestion would be no. But I would certainly talk with your auditors and see.
But he
you know,
has
what
signed a form.
He has signed a
Statement
form.
of intent, but
You
it's
know,
through a donor advised fund.
It's kind of sort of gray because you've got a signed document by the donor that says this is, you know, what I will be doing. But it's the wording that you kind of want to make sure you're really careful about. And that's why I was saying, you know, when you have those forms, you know, put the word pledge. This is, you know, this is I pledge to do this. Now, that's not to say that every pledge, as we know, materializes. We know that. But the wording is very particular. And in the audit world, if it was an intent, it's not as comfy cozy for us as I pledge.
I mean, if he chose to fill out the intent form as opposed to the pledge form, that does speak differently about how serious he is about it.
Well, it's the instrument he's using, which is the donor advised fund, which seems to be the crux of the matter, because in these two particular scenarios, the level of intent is the same. It's just that one is using a donor advised fund and the other is not.
But also, at the end of the day, he can't make the donor advised fund.
Right. I think that's where it comes in. And thus, the bottom line question that I need to check with our folks in DC, they may have resolved whether we can book that or not.
Yeah, it could very well depend.
So
Yes,
what
ma'am.
you're saying is Mr. Gottrox dies,
Right.
that intention is,
Well, and that pretty much applies to a pledge as well. So, you know, I mean, when you have it in writing, it's helpful, and when you use the word pledge, it's a little bit more solid for us, you know, accountants and auditors, where we feel more comfortable booking that. But, you know, if Mr. Gottrox dies, it's, you know, there's no guarantee for anything, whether he intended or he pledged. Good questions. It's very gray. By the way, accounting is very gray. Not what you wanted to hear, I'm sure. So the other thing we were talking about is net assets, which is the same thing if you're familiar with a for-profit industry as the equity section. And what represents net assets is made up of those three things we were kind of talking about before, is unrestricted, temporarily restricted, and permanently restricted net assets. And in your bucket of unrestricted, we have those surpluses or deficits, that unrestricted money that shows up there. We also have the board designated money. Again, as I mentioned, it could be for a project, a cash reserve, or acquisition, or something that you've set aside money for. It may also be money for property, plant, and equipment, whatever you might need. And again, we have temporarily restricted net assets. Again, those are restricted by the donor, by a time or a purpose, or both. So, you know, certain things can be said, you know, I want you to use this, as I mentioned before, for next year's, you know, programming, or for this program specifically next year. So it could be both. And then there's the permanently restricted bucket of net assets. Again, that's your endowment. And again, that's going to be restricted also by your donor. So, you know, we accountants back there are not just, you know, moving money and, you know, deciding. It's all based on, you know, how you're working with the donors and what the donor comes back and tells us their use for this money, or how they want their money used, and in what purposes. The net assets, by the way, I mentioned it equals, you know, equity. It's very similar to equity in the for-profit world if you're used to it. Even some not-for-profit agencies I've seen use just the word equity. Is just, you know, more comfortable internally, particularly for them to see that. They're more familiar with it. It's the same. And it appears in the same place on the financial statement, so I don't want anyone to get too uncomfortable with the word net assets or equity. It's all the same. So lots of good questions. Now I have some questions for you. Here's the quiz part. Are you ready? So if you can answer the questions, you get a prize. It's really exciting. Okay, which financial statement shows the organization's net value at a moment in time? A balance sheet. Yay, balance sheet. Very good. And I have some prizes. And I promised Mark I wouldn't move around too much. So I'll just hand this to you. And these are, really more for your finance folks, and including a handful of chocolate.
Oh.
So take a handful, yes.
All right.
Share with your finance folks. Finance loves chocolate as much and often. So when do you recognize the revenue of an unconditional promise to pay? That's tricky.
Say it again.
An unconditional promise to pay.
Never.
When you receive it.
It's unconditional.
When you receive it.
Yeah, immediately. Marsha, was that you?
I'll share it with somebody else.
We'll just nominate.
I'm going to give it to my neighbor.
Okay.
Who's already chewing your chocolate?
Give it to your friends. Okay. All right. One more. Is it ethical for a not-for-profit organization to be profitable?
Yes.
Oh, just throw the candy out. I know. This is like a garbage can. So poor Mark is like, okay, you're driving me crazy with the camera. I told you don't move around.
You're fine.
Okay, and one more. Why is it important for you to regularly review and understand your agency's financial statements? Okay, that was a trick question. There's responsibilities. Yeah. There are 15 answers. So yeah, it's really important. And my favorite one is it's your fiduciary responsibility. So you work for a not-for-profit. We're definitely counting on you to make sure that they're correct and accurate. But it's a benchmark, and it's going to tell you how your agency is performing. And because I'm a certified fraud examiner, I'm going to tell you that it's really important to be looking at your financial statements, because fraud is happening.
And you never know who it's going to be.
And it's the person you least expected.
Yeah.
Yeah. And so by looking at it, just the sheer fact that they know, they being the fraudsters, I like to use that word, fraudsters. Yeah.
You're a fraudster,
They're
sir.
going to, be a little more careful. And so just the sheer fact that you're looking at them can prevent fraud. You're going to immediately spot, and if you don't, someone else in the group who's looking at the financial statements is going to immediately spot something looks amiss, something's not right. It's not always a given. There are other ways that fraud is happening that you'll be able to pick up on it. But this is a good vehicle, a good avenue for sure. So I strongly encourage you to be reviewing your financial statements on a regular basis. So thanks for playing along. Yes.
Quick, ask a question.
Yes, absolutely.
I'm going to point this way when I ask it. It's been my experience that board members are very happy, wonderful board members. Look at the financial statements all the time, nodding sagely, saying little, being very happy to tell us where we should be spending money, but basically not understanding what the financial statement says. So my question to you is, can you give us a strategy for truly preparing a board member to understand the financial statement?
It's a very good question, and it's a tough one to answer, because you have board members who are come with a whole variety of background and expertise, and they're volunteers, and may not know what they don't know. What I have found to be the most effective is having a training, is having either someone within your organization or a board member who knows, or your treasurer, or hire someone. Like I said, I do presentations. It's not a plug for me, but I'm just saying it's important. Do a training, on your financial statements, on that organization's financial statements. Go specifically line by line, talk about them, explain them, show them what they're looking at. And do it annually with new board members, because hopefully your board members change on a regular basis. So just make that part of your training annually. Literally train them on, here are our financial statements. This is what you're going to see. This is what it looks like. This is what it's telling you. This is how we prepare them. This is why. And so, and then infuse in them the importance of understanding. And I agree with you. I've seen a lot of boards, they get the financial statements in advance of their meeting and they never look at them. And it's unfortunate.
Our CFO pre-chews
like a mother bird a little bit, the financial statement for the board members. And he has bullet points next to things that are relevant to their decision-making process because he knows what the agenda of the meeting is. So, and it's in layman's term, like, slow down here. This is good. Yay. You know, things that are terms we can all kind of grasp, and he doesn't assume they know. Because our financial statements are pages and pages and pages. And he'll have 5 or 6 that are pulled out with anyone can understand the terminology, and it's relevant to the topics they're talking about.
That's excellent. That's great. And then I've also seen situations where, while it's not commonplace, but maybe on an occasion your CFO can actually come to your meetings, the board meetings, and present them.
Board meetings.
Yeah. Some boards don't prefer to have that, but yeah, I mean, that's a great example. Excellent.
And that,
I'm sorry. Go ahead.
go ahead.
Thanks. What point would you say that a nonprofit should get an audit? What budget amount would sort of be the point at which you should start thinking about an audit?
It depends.
I was afraid you were going to say
Usually-
that.
I know, because it's gray. So that's my favorite color. What I find is it depends on, do you have a particular grant or a reason for an audit? That's when I would get an audit. They can be expensive. I didn't say that. Do not tell your auditors I said that. But they are, and it's excruciating sometimes of a process to go through. It's a good one, and I do encourage all nonprofits, regardless of your size, to have some external review. It doesn't have to be an audit. It can be a compilation. It can be a review by an external CPA. It can also be simply an outsourcing of, hey, can someone who's a CPA or who works as a controller for another nonprofit, can we hire them to come in and just take a look at how our processes are? Do things look on the up and up? And are our financial statements being entered and presented correctly? So that's a cheaper alternative, but I strongly suggest that. But for an audit, I would suggest that it's based on whether or not it's required, if you need it for a particular grant or something.
Okay, thanks.
Yes, ma'am.
There are funders out there who will allow you to write a grant, and part of that grant can be funding for an official audit. And the purpose behind that is so you can build your capacity, because if you are able to apply for those grants that require official audits, they're usually for larger dollar amounts. And if they allow you the money to get the official audit, then you can grow the capacity of your organization. And we've done that with several organizations I've worked with successfully. And that way your first audit is at least paid for, so you have the tools to go and apply for the bigger grants that you need, and then you can continue your audits from there forward.
That's excellent. That's a great suggestion. There's so much out there. How do you all do it? There's so many opportunities. So great questions. Did I miss anybody? Anybody have any more comments
got
or
one
questions?
more.
Yes, sir.
Since you're here, if we find ourselves with a scandal caused by fraud, what do you think we should do?
I think immediately you should call somebody who is either a certified fraud examiner or knows how to help you identify sort of the situation you're dealing with, because sort of like any bad thing going on, you kind of don't want to disrupt the apple cart too quickly or too soon before you fully understand exactly what may be happening. You can do an investigation. You can do, sort of an assessment. If you have found it absolutely beyond a shadow of a doubt, and I've had that situation where, we know for a fact that she's been, was actually, writing false checks. And she had gone to lunch, and it was discovered by the bank. Bank called the controller at lunch while she tried to cash a bad check from the agency. It was a not-for-profit. And immediately the controller, as soon as she went to the president, the executive director at the time, and then when she came back from lunch, called her in the office and terminated her right then and there. So that you do want to, if you find it for sure, exactly, terminate. Just do what you have to do. But then you want to get an investigation. But if you suspect or you're suspicious something is going on, then I would suggest you, get an investigation, try to understand the magnitude of what's going on and what you're dealing with, and then make decisions as to how you need to move forward. Because it might not be a fraud going on, but it could be.
Well, what if all of a sudden we're realizing, okay, we have our nice investigation, all the people are in place, it's going to take 2 weeks or 2 months, and the newspaper gets a hold of it?
Yeah, it's tough, and so you want to kind of keep that under wraps so that you can try to preserve your reputation. I mean, the communication is key, and that's why it's important to kind of get people who are experts in this, who know how to handle the situation and make sure they're doing it carefully to preserve your integrity as an agency, for sure.
Well, that's what I was going to bring up, because my first skill is PR. And so as you begin to work through finding this out, oftentimes the PR person is the last to know because it's a personnel issue. But the PR person, whether it's on staff or whether it's a crisis communications expert or consultant, as I've done before in the past, they need to be at the table sooner than later, so that you can start to control messages. And it's not just your external audience. The newspaper is also your internal audience. For example, your donors and those kinds of things. So
That's right. It's a really tricky situation. So you bring up a really big can of worms. But for sure, find the experts. If you suspect it, get it under control. Understand what you're dealing with, and for sure, make sure you've got a PR plan for both internal and external, communication. So that's a whole other topic.
Well, I'll just mention that I was up to my ears in the Covenant House scandal in 1990. It was a long time ago, but from the PR standpoint, I would say that if we are not forthcoming with our donors, and they've got it through all sorts of media, this was national.
Yeah.
Then we are shooting ourselves in the head.
Yeah.
And so we didn't wait for any confirmation. We just started in with the donors.
And that's certainly a decision as well. Absolutely. So just to wrap up, because I know you guys are ready to go back to work, getting more money. So again, hopefully what we were able to do is just sort of touch upon some core key concepts that you can apply to any financial statement, and that you'll go back to your finance department right now and ask for those financial statements. So remember, who it's coming from. Us accountants are from Mars. That means you non-finance people are from Venus, just so you know. Make sure you're asking questions. Understand, where the statements are coming from, where's the information, what are these statements for, how is the data being presented, and how are you needing that data and reading that data and interpreting it. And remember, financial statements are just really a piece of the puzzle. You have to take them in combination with everything you're looking at, with all the information you have about your agency. There's different styles, different forms. Some are reviews, compilations, audits, internal financial statements for funders or grantors. They come in all different sizes. And again, like I said, with just these few basic concepts, really you can apply them to any set of financial statements. And being good stewards and working with your board to make sure that they are reading those financial statements regularly is really important. And some good ideas and suggestions. Audits or external folks to come in and check your processes or come in and train your board, all very good suggestions. So if there are any more questions, I'd be happy to take them. That's all I have for you today.
Okay, Michelle, thank you very much. All right, and I'm glad to say that this seems to be sort of the financial corner of our year, because next month in October, Carter and Carter Associates are sending in some folks to talk about more about audits and the 990, as well as that. And then I'll tell you now, in October, our meeting will be a meeting with Scott Buchanan from Care Partners Foundation. If you've noticed, Care Partners has done a very interesting job of doing unrelated business income activities in order to fund their foundation. And a lot of us are trying to figure out, okay, what else can we do with our nonprofit to actually make some money in a for-profit way without doing a thrift store, since there are a bunch of those. And there are some great ideas that we're going to hear about in October. Okay? Any further announcements before we break up? Thank you all for coming, and we'll see you next month.
I do.